Crude just ripped the face off anyone holding longs. Overnight, Brent collapsed 4.27%, wiping nearly $4 off the barrel, and it's not the speed that matters. It's the narrative that died in a single headline. Trump cancelled the planned strikes against Iran, and with that, the entire geopolitical risk bid that had been artificially propping up oil was executed. But here's the real trap. The market never even believed in that premium. The rally was already muted, the option skew was fading, and the commercials were selling into every spike. Now you're seeing the liquidation of late longs who chased the Hormuz story. That pain is not over. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade tomorrow. This is your instant market verdict for Brent crude on the session we are currently trading. The bias is unequivocally bearish, pure trend fading on any pop, and sell on strength until proven otherwise. We are not range-bound. We are in an accelerating downtrend with an ADX reading above 39. Anything above 25 is a trend, above 35 is a beast. This beast is running lower, and trying to catch a bid before we hit a structural support is swimming into a liquidation cascade. The single level that flips the entire bearish structure back to neutral, and then potentially to a short squeeze, is the pivot point at 92.96. Right. This number down, if we break and close a 4-hour candle above 92.96, the entire sell-off structure resets and the trap snaps on the early shorts. Until then, every bounce is a reload. Here's why that matters for the herd. I'm seeing retail positioning still net long, expecting crude to bounce back because it fell too fast. The CTA community, however, just flipped mechanically short below 95, and long-only commodity funds are hitting risk limits. That means there is a gigantic pocket of stop losses sitting just below the 89.73 support and the psychological $89 handle. When those stops are triggered, they won't be filled gently. They'll be the fuel that sends us into a free-fall liquidity grab. That's your edge. Be the hunter, not the hunted. Let's go into the technical deep dive. And I'll start from the top of the timeframe ladder because the story gets ugly when you line up the moving averages. On the weekly chart, Brent is in a sell program. The 20-week moving average is sloping down, roughly around 97.50, which coincides with the top of the recent dead cat bounce. The 60-week equivalent is curling lower above that, and price is now breaking back below the weekly midpoint after rejecting the weekly R1 near 95.15. This is a classic bearish continuation structure. Now zoom into the daily chart. This is where most traders miss the gravity of the setup. Price is trading at 89.11, which is below every single relevant daily moving average except the 200-day, which sits way down at 83.94. The 20-day moving average is at 96.25. The 50-day, our institutional proxy for the 60-day, is at 96.71, and the 100-day at 91.97. So the daily moving average ribbon is now a massive overhead supply zone. The price tried to reclaim the 100-day this month and failed miserably. Now it's accelerating below the 5-day and 10-day, which are at 92.09 and 93.85 respectively. That is a textbook bearish alignment, and the slope of the 20 and 50 are both pointing down. The 200-day at 83.94 is the ultimate magnet, and I'll tell you why that matters for target development later. The daily MACD is not just negative. It's printing minus 2.54 and the histogram bars are expanding below the zero line. There is no bullish divergence on the daily RSI, which is sitting at 38 and falling, meaning momentum has room to run before we even think about being oversold. Stochastics are at 36, Williams %R is pinned near minus 95. This is a trend that wants to stay oversold in a downtrend. The daily support structure is clear. First, the overnight low area at 89.73, then below that, the big support at 86.69, which aligns with the previous volume node and the S3 pivot. Resistance is at the broken psychological $90 handle, then the pivot 92.96, and only above that does the picture change. Now, here's what most traders miss when they drill into the 4-hour and 60-minute time frame. On the 4-hour chart, the moving averages are a cliff. The 20-period 4-hour MA is collapsing through the 94 handle, the 60 is around 95 and change, and the 200-period on the 4-hour, a level institutions watch like a hawk, is sitting near 98.50, miles above. That means even on a short-term bounce, the odds of a V-shaped recovery are nearly zero because the distance to any dynamic resistance is too large to overcome without a fundamental catalyst. The 4-hour MACD is deeply negative, and I'm seeing no hidden bullish divergence on the 60-minute either. In fact, the 60-minute chart is painting a series of lower highs and lower lows, with every pop being sold at the 9-period exponential moving average. Right now, the 60-minute 20 MA is sloping down around 90.20, acting as dynamic resistance. The only thing that could stop the bleeding temporarily is an oversold bounce from the 60-minute RSI, which is flirting with 25, but in a strong trend those bounces are brutally short-lived. The cross-asset linkage here is visceral. Brent's collapse is dragging the entire energy complex. WTI is leaking, gasoline futures are down. And importantly, the Canadian dollar is getting hammered because it's the petrocurrency proxy. Simultaneously, the US dollar index is firm above 105, adding a second layer of pressure. Gold is not getting a safe haven bid from this. Instead, gold is falling with real yields ticking up slightly, confirming this is a liquidity-driven risk-off move, not a fear trade. That tells me the oil move is genuine deleveraging, not just a headline spike that reverses. Let's connect the 24-hour news to the price action and build the narrative web. The trigger was Trump explicitly canceling military strikes on Iran. That single sentence unplugged the geostrategic bid that had been keeping a floor under crude. But here's the deeper insight that the herd is ignoring. For the last 2 weeks, every time we got an Iran-related headline, oil would spike 50 cents and then fade. The muted rally was the signal. The market had already adapted to Hormuz closure risk. Tanker rates had started to normalize, insurance premiums were slipping, and flows from the Strait were continuing. The market was pricing a low probability of actual supply disruption. So when the cancellation hit, there was no genuine war premium to unwind in terms of a physical shortage. Instead, it was the clean-out of speculative length that had built up on fear, not on fundamentals. Now layer in policy divergence and demand. The macro backdrop is weakening. European PMIs are soft, Chinese crude imports are showing signs of plateauing, and the IEA just nudged down demand growth forecasts. So you have a supply shock that never was, meeting a demand scare. That is the perfect storm for a sustained leg lower. My 1 to 2 week directional lean is further downside toward 86.69. With a risk extension to 85 even if broader risk-off intensifies. The invalidation that would flip this narrative on its head is not a small headline. It's a sudden OPEC plus emergency meeting or a verified blockage in the Strait. Absent that, this trend has institutional sponsorship. I'm going to ask you right now, do you think Brent touches $85 this month? Comment yes or no below. I'm tracking consensus against the CTA positioning. Your answer tells me if the crowd is still in denial or if we are closer to a capitulation bottom. Now the part that separates the profitable from the hopeful, the trade setups. Most people skip this section. That's exactly where the money is made. Keep watching. I'm giving you 3 concrete strategies, each with a sniper entry, stop, targets, and the exact invalidation. Strategy 1 is the sniper, the conservative play for those who want to short into strength with confirmation. We wait for a pullback into the newly broken support-turned-resistance zone around the psychological 90 handle and the key near-term level of 90.92. The entry trigger is a 1-hour close at 90.90, combined with a bearish engulfing candle or a failed retest of the hourly 20 moving average, which will be declining into that area. This aligns with the logic that former support becomes supply. The stop loss goes at 92.50. Just above the pivot zone and the hourly 60 MA, giving room above the intraday noise. That's a 160-tick risk, but with ATR at $4.5, a stop below the pivot keeps you structurally aligned. Take profit 1 is at 89.10, which captures the move back to the lows. Take profit 2 is at 86.75, just below the S3 support, giving you a risk-to-reward ratio of roughly 1 to 2.6 on the full target. This trade is void if a 4-hour candle closes above 92.96, because that would signal a structural failure of the downtrend. The sniper, conservative, entry, 90.90, 1H close above, with bearish engulfing rejection, stop loss, 92.50 take profit 1, 89.10 take profit 2, 86.75 risk, reward, -1 2.6 invalidation, void if 4H candle closes above 92.96. Strategy 2 is the active trader, a mean reversion fade for those who want to engage the trend without chasing the intraday collapse. This setup uses the current momentum exhaustion on the 15-minute chart. Right now we are massively oversold on the short-term oscillator. Wait for a shallow bounce that stalls at the 15-minute 20 MA, which will likely be around 89.50 to 89.70. Enter on a 15-minute close below 89.40 with a bearish pin bar or a break of the recent consolidation low. Stop loss above the intraday swing high at 90 even. That's a 60-tick stop. Take profit 1 is 88.40, and if that breaks, we trail the stop to break even and target 86.90. The trailing stop after TP1 is a 15-minute close above the 9 EMA. This is a standard trend continuation play with an improved risk profile because you're entering on a failed bounce. I want you to type your Brent range for tomorrow in the comments right now. Give me a high and a low. Let's see who's aligned with the order flow. The active trader, standard, entry, 89.40, 15-minute close below, after stall at 15 M20 MA, stop loss, 90.00 take profit 1, 88.40 take profit 2, 86.90, trail stop to break even after TP1, risk, reward, 1:2.2R to TP1 invalidation. 15-minute close above 90.15 voids the bearish sequence. Strategy 3 is the aggressor, the high-risk, counterbounce fade for those who can handle heat. Because we are down over 4% and emotions are running wild, there is a high probability of a short-lived short squeeze. The aggressor shorts directly into that squeeze. Wait for a spike toward 89.80 or the 90 area, then look for a 1-minute rejection candle with a long upper wick. Enter at 89.90 with a tiny stop at 90.25. That's a 35-tick stop. Target 1 is 89 even. Target 2 is 86.70. The risk-reward on the second target is aggressive, potentially 1 to 7, but the win rate is much lower. Only take this if you can lose small and manage risk aggressively. Invalidation is any 5-minute candle close above 90.30, which would signal the squeeze is real and you step aside. The aggressor, high risk, entry, 89.90, 1-minute bearish rejection after spike, stop loss, 90.25 take profit 1, 89.00 take profit 2, 86.70 risk, reward, -1:3.2R to TP1 invalidation. 5-minute close above 90.30 cancels the fade. Listen closely. Never risk more than 1% per trade on Brent right now. With daily ATR above $4.50, leverage will destroy you if you don't respect the range. No positions through high-impact news like EIA inventories or FONC minutes. Stops are non-negotiable. This is how you survive to trade the next big move. Here's what you need to take away. The single most critical level for the next session is 92.96. If price stays below, the bearish structure is intact and all bounces are selling opportunities toward 86.69. A daily close above that level, and the whole short thesis needs a rethink. Tomorrow's wildcard is the weekly EIA crude inventory report. If we see a surprise draw, we might get a bounce that tests the newly minted resistance at 90. But until then, the geopolitical heartbeat of oil has flatlined for the bulls, and the path of least resistance is painfully clear. If you want the full breakdown on how the S&P 500 is reacting to this energy shock and the divergence in equity gamma, that video is live right now. Tap the end screen. Smash like if this gave you a clear plan, subscribe, hit the bell, and I'll see you in the next one.